It's another earnings season for the three Keppel Reits. The earnings has been a mixture, with Keppel DC Reit performing well while Keppel Reit and Keppel Infrastructure Trust has not performed that good. Now let's get right into their respective results. Keppel DC Reit is one of the rare REITs in Singapore that has been very impressive so far, definitely benefiting from the cloud demands in data centers due to the development of AI. Even with the exclusion of Guangdong data centers tenants' income, which is 5.5% of their assets, they are still able to report higher income and higher dividends. Of course, I will look forward to seeing them announcing about the Guangdong DC tenants issue soon. This can be seen from their results. Revenue continued to grow year over year by 8%, while net property income increased by 8.5%. Interestingly, Keppel DC Reit managed to put funds into deposit to earn interest, thus having a higher finance income of 84%. Finance cost is stabilizing while property expenses is higher due to the Guangdong data centers and new data center properties expenses. With the revenue and income increasing so much, while property expenses and finance costs did not increase as much, Keppel DC REITs is able to announce higher distributable income of 20%, while DPU of 13.2% if we compare between the half comparisons. So if we compare the year-over-year results for full year of 2023 and 2024, it looks quite normal because the DPU only increased by 1.3%. However, what is so impressive is that for the financial year of 2023, it included the 5.5% income from the China assets, while the full year of 2024 did not. So this is a big plus for investors as they are still managed to get higher dividends even without the 5% contribution. In the future, I'm sure that they will be able to resolve the Guangdong situation, and when this income comes back, this will definitely benefit the DPU. With regards to Keppel DC Reit's leases, it continues to perform strongly with 39% rental reversion, which is very fantastic. There's no other REITs that can manage such high rental reversions other than Keppel DC Reit. This meant that because of the cheap lower rental leases that expired and the high demand in the data centers, Keppel DC Reit is able to renew these leases at 39% higher in the income. This is one of the main factors why this is making Keppel DC Reit stand out above the other REITs. With good rental reversions, it's always desired to have lease expiring as the renewed leases will definitely allow REIT to earn higher income. For this year, I expect their income to continue to increase organically as they have 15.4% of their rental incomes that are expected to be renewed. If the rental reversion is above 30%, it's definitely a big win. For the debts, because of the fund equity raising, leverage ratio has dropped drastically to 31.5% from 39%. This is good because this meant that Keppel DC Reit has a low debt levels to potentially fund for new potential data centers. Debt maturity is not a big concern for Keppel DC Reit for this financial year. With higher rental reversions that allow Keppel DC Reit to grow their income, refinancing debts in full year of 2026 and 2027 should not be an issue for them. The concern that the investors might consider is the land lease for data centers in Singapore. They have recently bought Keppel DC Reit Singapore 7 and 8, but they only have 15.5 years of land lease even though they are new. In my opinion, the extension of the land lease should not be an issue, but the money that is required will have to be observed. Overall, with the leases continue to renew at a very good positive rental reversions, Keppel DC Reit dividend will be expected to continue to increase this financial year. Even though it's a very good REIT, it's a very pricey REIT as well. There are potential dividend growth, but with the dividend yield at 4.3%, you have to ask yourself if this current dividend yield will be attractive to you. Now let's go on to the next Keppel dividend stock, and that is Keppel Infrastructure Trust. Keppel Infrastructure Trust is a business trust. However, it's different from REIT is that they do not need to meet the 50% leverage ratio set by the government for the REITs. KIT contains a lot of different essential asset classes from renewable portfolios like wind farms and solar platforms, gas plant to oil pipelines, waste to energy plants, water treatment plants, and distribution and storage. These different classes are essential businesses that are related to utilities, which makes KIT business so resilient. However, good business does not guarantee good profit. With the aggressive acquisition by KIT management, it's important to monitor the return of the assets. Similar to REITs, distributable income is the most important parameter. It determines how much income there is to distribute to shareholders as dividends after deducting all the expenses. I've actually broken down the business into quarter-over-quarter results. So for this quarter, City Energy, Aramco Pipeline and KMC performed decently, similar to Q3 results. European wind farm finally start benefiting KIT again, with 9 million return compared to the negative 13 million due to debt payments. However, the new asset German Solar Ampere came in at negative 3 million. Seems like it's a trend for it to have one quarter positive while the other quarter is negative. Singapore water assets improved to 15 million and I expect it to continue increasing considering the purchase of the Marina East desalination plant back in November. EMK performed fine this quarter with 5 million. Good thing is that their business is more efficient with lesser capex. However, to me, EMK business is still a disappointing one. Distribution and storage performed fantastically this quarter as expenses have been paid off from last quarter. Ixom came in high at 46 million, while Philippine Coastal was good with higher income after the tank storage expansion. Ventura also came in good at 18.9 million, which we will see if it can continue this high amount of return. So for this half, distributable income available to shareholders is 112 million. However, if we look at the financial sheet, we can easily find the dividends paid to both shareholders and perpetual securities. With the dividends declared, their dividend payout ratio is around 143%. This is not good because any dividend payout ratio above 100% means company have to fork out additional fund just to pay the same dividend, making it unsustainable. That is one of the reasons why KIT dividend had never really increased and the share price is priced low due to this payout ratio risk. Another way to gauge their dividend payout ratio is to look at their funds from operation. FFO is the profit before maintenance or debt expenses. So if we see there, FFO is 143 million, which makes the dividend payout ratio close to 100%. But because they have debts and growth capex, that resulted in distributable income to be 112 million. Debt payment is always a problem as assets suddenly would not be able to contribute to the total distributable income due to debt repayment. We can see that debt maturity for BKR2 and Philippine Coastals are maturing soon. Hopefully there's enough cash for this debt payment for these respective assets. For their summary balance sheet, gearing ratio is at 40.9% with interest coverage ratio of 7 times. Average cost of debt is very high at 4.51% and hopefully with this high level of debts, this might be the peak for KIT. Compared to some REITs, this cost of debt is already at a very high level. For KIT, they will have a big loan to refinance in financial year of 2026 which will not come so soon. However, with their cost of debt at such a high level, I do not expect much changes even if refinancing is required. So for KIT this quarter, some assets are performing decent while some assets did not perform as well. Above 100% dividend payout ratio will continue to be a risk for KIT. At the current share price, the dividend yield is at an attractive level of 8.7%. But with the current situation, I'm not very optimistic for their current dividends to go up. Let's go on to the last REIT and that is Keppel Reit. Keppel Reit is one of the rare commercial REIT that is performing well thanks to their high percentage of assets in Singapore. So it will be interesting to see how their overseas properties perform as well. If you have followed the other commercial REITs, a lot of their overseas properties are not performing well. For their full year highlight, NPI went up by 10.7% year over year, but DPU actually went down by 3.4% year over year. Like I mentioned previously, the main expenses of REITs are property operating expenses and borrowing costs. So from this, we can already know that it was mostly due to the increase in borrowing costs, which we will see later. However, good news about Keppel Reit is that their rental reversion is still very strong at 13.2% for their portfolio. This is very impressive considering commercial properties have a lot of warnings where companies are cutting down on office spaces. This further justifies the good quality office spaces that Keppel Reit has that are attractive to tenants. Looking at their balance sheet, revenue and NPI both increased double digits, which is good. However, the main problem is the increase in the borrowing costs by 34.3% year over year. This is the main problem for most REITs. With the debts refinancing at a higher interest rate, borrowing costs will definitely go up. This led to a lower DPU of 3.4% year over year. Looking at their debt profiles, even with their income increase, it's not so good because their interest coverage ratio actually dropped from 2.7 times from last quarter to 2.5 times. Average ratio is stable at 41%, but interest rate cost continues to increase from 3.38% to 3.4%. My concern is still the same as they have to refinance 23% of their debts in financial year of 2025. A REIT can have good properties, but with high interest debt refinance, it will still pull down their dividends. They do not break down the rental reversions for the properties in the respective countries, but we can see that Singapore continues to perform well. For Australia and other parts of Asia, their properties are doing decent with Australia occupancy continue to increase, while North Asia is at a fantastic occupancy of 100%. My assumption is that most of the high rental reversions comes from Singapore properties, with new leases signed at $12.56 per square feet, while leases expiring in financial year 2025 are expiring at $11.31 per square feet. We can safely assume that there will be positive rental reversions. Overall, what can we conclude from Keppel Reit's results? First, good rental reversions with good properties. Higher occupancy with Australia office properties continues to improve. However, large increase in the borrowing costs might be a risk for Keppel Reit. The concern will be the large amount of debts that needs to be refinanced in the financial year of 2025. At the current share price, its dividend yield is around 6.7%, which is decent. But with the risk of refinancing the debts in financial year of 2025, it might continue to increase their borrowing costs and drag down the dividends. In conclusion, Keppel DC Reit continues to be the standout performer out of the SG REITs. To me, they are the least concerned for DPU drop, but the dividend yield is low for a REIT. For KIT, we will continue to see if their new assets can bring in good income like Ventura bus business. The main goal is still for them to have dividend payout to be less than 100% so that they can potentially increase their dividends in the long term. For Keppel Reit, the commercial properties are doing fantastic, but it's just being dragged down by the large increase in the borrowing costs. Thank you so much for watching. Please support the channel by hitting the like, subscribe, and comment on your thoughts on the 3 Keppel Reits results. You can watch my recent analysis on Mapletree Reits or the Singapore banks. Thank you, and I'll see you in the next video.